Howdy, Jacob here. Today we're looking at Torrid Holdings in the specialty retail industry, 736 million market cap on a billion enterprise value. They operate in women's plus size apparel in the North America region. So they are geographically centralized and their insider ownership is 11%. So good amount of board members or CEO, CFO, management owns a lot of shares. That's a good metric to have for a smaller company. Growth is not very impressive. 909 million in revenue in 2019 to 1.1 billion in 2024. I mean, there's just a lot of competition in this world, in this realm, in this industry. 36 to 40% gross margin with consistently positive operating margin, which is good. Good that they're always, at least the last 6 years, making money. Their sales general and cost of goods sold is really all they got. Obviously, some interest-bearing debt because they have some debt. So 12 million cash on hand with 23 million short-term debt, 289 million long-term debt. It's a good amount of debt for me. So let's say 300 million in relation to their free cash flow. In the recent free cash flow is about 10 times. If they're able to get back to that $100 million free cash flow, then obviously you're less concerned about that. But for me, just looking at the numbers right now, I am a little bit concerned because I think competition, at least post-COVID, has exploded in this industry. And I think that it's going to be more difficult to have powerful margins without a moat or some sort of barrier to entry, whether that be your Amazon dominance that everyone has, goes through you type thing, or whether that be you just create such a niche product that no one else can create it. I don't think that's very niche. And so these assumptions are going to be with that in mind. And so I'll be likely more conservative than actuality, but I'm fine with that because I want to buy companies at obviously cheap prices. And when there's no moats and a lot of competition, I'm not interested in buying that business unless it's as obviously cheap as can be. So for revenue growth, I don't know if they're going to be positively growing. I will assume they do, but really, in actuality, it could be different. Margins are extremely low. Let's do a little bit of a range here, 3 to 5%. Looking for 15. Share change. They're making a little bit of money, but they're not buying back many shares with it. At least they probably won't buy enough to offset stock-based compensation. So 7 million is reasonable to do that with their free cash flow. So I will say, 20%, 25% of free cash flow goes to reducing shares. And then a lot goes to debt reduction. So for me, to delever. So for me right now, Josh needs to drop 62% before you get the return I'm looking for here. Again, not obviously cheap for me to want to get into this immediately, but interesting company, one that I'm going to need to get at a very cheap price. Hope you enjoy the video and have a great rest of your day. Thanks.